This is your entry point into understanding how judicial decisions ripple through asset valuations and institutional confidence. When the Supreme Court dismantled the immunity doctrine, it didn't merely resolve a legal question, it exposed the architectural fragility upon which modern capital markets rest. The court's ruling crystallized a critical reality: institutional legitimacy, once questioned, triggers cascading doubts through every layer of the financial ecosystem. Warren Buffett's immediate response underscored what seasoned allocators comprehend instinctively. Political uncertainty translates directly into elevated discount rates, compressed valuations, and a sudden repricing of tail risks previously deemed improbable. This is not abstract theorizing. The machinery of trust, the invisible scaffolding supporting trillions in asset bases, operates on the assumption of predictable governmental structures and reliable judicial arbitration. When that framework demonstrates volatility, even institutional investors must recalibrate their confidence coefficients. The intersection you're entering demands precision. Understanding how political fragility metamorphoses into market instability requires decoding the hidden transmission mechanisms, connecting constitutional precedent to portfolio risk. This channel exists to illuminate those mechanisms. Now that we've established our purpose, let's decode the headline that shook markets this morning. The Supreme Court's denial of presidential immunity represents far more than a legal verdict. It signals a fundamental crack in the institutional guardrails investors depend upon for predictability. When the highest court rejects the executive's claim to blanket legal protection, markets confront an uncomfortable truth: no entity, regardless of perceived power, operates beyond systemic constraints. This ruling destabilizes the confidence architecture that undergirds asset valuations. Institutions derive their strength not from invincibility but from credible, enforceable limitations. The moment those boundaries become contestable, capital seeks refuge. Warren Buffett's measured response reflects this calculus. Seasoned allocators recognize that political uncertainty cascades into economic friction. Regulatory unpredictability erodes the risk premiums built into long-term investments. When institutional trust fractures, whether through judicial intervention or executive overreach, liquidity withdraws. Spreads widen, and the hidden leverage embedded in seemingly stable portfolios suddenly surfaces. The market's delayed reaction masks an underlying unease. If even immunity can be revoked, what other assumptions warrant re-examination? The Supreme Court's decision signals a deeper fracture, one that the financial system has been pricing as already resolved. Yet, this reveals the central paradox that underpins modern markets: stability theater masquerading as constitutional certainty. For decades, institutional investors have constructed elaborate risk models predicated on the assumption that legal frameworks remain immutable, that the judiciary serves as an anchor against systemic uncertainty. The immunity denial exposes this fiction. When foundational pillars of governance become contested terrain, the market's implicit collateral trust in institutional permanence depreciates silently. Buffett's measured response itself betrays anxiety. The oracle signals through restraint what others panic into volatility. This is the mechanism markets fail to adequately discount, not the immediate political outcome, but the erosion of the confidence substrate upon which trillions in asset valuations rest. The Constitution was never the safe harbor markets priced it to be. It was always contingent, always reinterpretable, always subject to the next judicial configuration. When this realization crystallizes across portfolios simultaneously, liquidity evaporates before price discovery even begins. Block 4. Why Warren Buffett's response matters. Buffett's public statements carry outsized weight because they signal institutional confidence. When he speaks cautiously, The market listens. This phenomenon transcends mere celebrity worship. It reflects a fundamental structural reality about modern capitalism. Markets function on collective belief systems, and Buffett operates as a confidence barometer for institutional capital. When the Oracle of Omaha telegraphs concern regarding political uncertainty or judicial intervention, he's effectively flagging potential systemic risk that institutional portfolios cannot ignore. His silence carries equal gravitas. The Supreme Court's immunity ruling creates unprecedented constitutional ambiguity around executive accountability, directly threatening the rule of law foundations that underpin investment security. Buffett's measured response neither dismissive nor alarmist suggests he perceives genuine macroeconomic implications. This cautious posture matters because it influences capital allocation decisions across trillions in assets. When confidence anchors fracture, liquidity evaporates rapidly, exposing hidden leverage throughout the system. The market's stability depends less on actual fundamentals than on shared perception of institutional legitimacy. Buffett knows this calculus intimately, which is precisely why his words function as a canary in the coal mine for systemic fragility. Most analysts focus on the verdict itself. We're asking what structural assumption the markets have been relying on that just cracked. The Supreme Court's rejection of presidential immunity demolishes a cornerstone of executive stability that institutional investors have quietly priced into their risk models for decades. This is not merely a legal decision, it is a rupture in the confidence architecture that underpins governance premiums in equities. Markets have historically discounted political risk by assuming executive discretion operates within protected parameters. That assumption has evaporated. What we're witnessing is the sudden repricing of institutional continuity itself. When Buffett's silence speaks, louder than his traditional commentary, it signals recognition among sophisticated capital that the leverage underlying multiple valuations built on predictable regulatory environments. And executive continuity now faces unforeseen stress. The hidden fracture isn't in the courthouse. It's in the foundation of trust-based systems that haven't been truly tested in this form. Asset prices reflect collective assumptions about how institutions function. When those assumptions collapse overnight, the contagion spreads silently through illiquidity thresholds and crowded exits, leaving only the observant positioned defensively, with the central question framed. We must understand the legal foundation that made immunity seem settled. The doctrine of presidential immunity emerged as a structural mechanism designed to insulate executive decision-making from judicial interference, a safeguard born from Cold War anxieties about institutional paralysis. However, this architecture rested on an implicit contract that institutional actors would self-regulate within constitutional bounds. Markets, fundamentally, price stability based on predictable rule systems. When the Supreme Court's recent decision dismantles decades of settled legal precedent, investors face a recalibration of systemic risk that extends far beyond constitutional law. The immunity doctrine functioned as a confidence mechanism of belief that executive power carried internal constraints. Its collapse signals that even foundational institutional protections possess latent fragility. This precedent-shattering verdict introduces legal uncertainty into the political apparatus itself, creating what financial analysts term regime risk, the possibility that fundamental governance rules can shift abruptly. Buffett's measured response reflects institutional recognition that stability assumptions require constant validation. When constitutional architecture fractures, the cascading effects ripple through asset valuations, credit spreads, and long-term capital deployment decisions. Trust, once broken at systemic levels, proves extraordinarily difficult to restore. Markets are forward-looking mechanisms that price in assumed stability. Presidential immunity was one such assumption. For months, traders embedded this uncertainty into their models as a binary outcome, either fully protected or entirely exposed. The market never truly priced the third scenario, a judicial intervention that rewrites the constitutional rulebook mid-game. When the Supreme Court rejected immunity, it didn't merely settle a legal question. It detonated a foundational assumption upon which risk models had been calibrated. This is the hidden mechanism of systemic fragility. Investors had constructed elaborate hedging strategies, positioned portfolios, and allocated capital based on implicit confidence in institutional predictability. The court's decision wasn't just news, it was a recalibration shock that forced immediate repricing across multiple asset classes simultaneously. What appeared as stable certainty revealed itself as speculation dressed in the language of fundamental analysis. This is precisely how confidence-based systems fracture, not through obvious collapse, but through the sudden recognition that the floor beneath was always made of assumptions, not concrete. Here's where the technical mechanism begins. Uncertainty in governance creates a chain reaction in risk valuations that extends far beyond courtroom verdicts. When constitutional guardrails erode, particularly those protecting executive power, institutional investors recalibrate their discount rates upward, a phenomenon known as the political risk premium. This isn't theoretical abstraction. It manifests in measurable basis point increases across sovereign debt spreads, currency volatility, and equity volatility indices. The Supreme Court's immunity denial catalyzes immediate repricing across three critical vectors. First, regulatory confidence deteriorates as market participants question the durability of legal frameworks. Second, long-duration assets face downward pressure as terminal discount rates expand. Third, capital flight accelerates toward perceived safe havens. Buffett's measured response signals. Acknowledgement of systemic fragility. Established wealth recognizes that markets function on collective faith, not fundamentals alone. When that faith fractures, cascading redemptions transform theoretical risk into realized losses, weaponizing the very interconnectedness that modern finance has constructed as its cornerstone. Buffett's response isn't casual commentary, it's a sophisticated signal about how long-term institutional capital is reassessing exposure. When the oracle speaks, markets listen not for what he declares explicitly, but for what his silence on certain positions conveys. His measured tone regarding political uncertainty masks a deeper calculation. The erosion of institutional confidence in governance frameworks directly threatens asset valuations predicated on regulatory stability and rule of law protections. This isn't merely opinion. It's capital allocation strategy disguised as philosophical reflection. By refraining from aggressive positioning while simultaneously acknowledging systemic fragility, Buffett signals that even Berkshire's fortress balance sheet views prolonged political instability as a headwind to long-term returns. The subtext is stark. When the world's most disciplined allocator becomes cautious about legal and institutional architecture, retail investors should recognize this as a red flag embedded in institutional psychology itself. Markets function on confidence gradients, and when that gradient weakens among sophisticated players, contagion accelerates faster than most acknowledge, while the Supreme Court rules on law. Markets respond to belief in the stability of rules themselves. This distinction is not semantic, it is the operative mechanism that separates orderly markets from systemic collapse. When judicial decisions erode investor confidence in institutional impartiality, the psychological foundation supporting asset valuations begins to fracture. Warren Buffett's measured response signals what sophisticated capital already comprehends. Legal rulings matter less than the market's perception of whether those rulings genuinely protect property rights and contractual sanctity. The moment investors question whether courts serve wealth protection or political accommodation, a cascading withdrawal of capital becomes rational, not panicked. Confidence, in this context, functions as an invisible but measurable variable, one that determines liquidity, leverage ratios, and ultimately, systemic stability. When confidence evaporates, precedent becomes worthless, assets repriced overnight. This is not theory. It is documented repeatedly across financial history. The real risk is not the Supreme Court's decision itself, but the erosion of faith that fuels every transaction in the financial infrastructure. We've seen this pattern before the Dred Scott decision. The New Deal constitutional crisis each destabilized asset classes for years. When courts overturn foundational legal assumptions, markets don't merely correct. They undergo profound reevaluations of systemic risk. The Supreme Court's immunity denial operates through an identical mechanism. It collapses the perceived legal protections that institutional investors had implicitly priced into equity valuations and political risk premiums. Historical precedent reveals that such rulings trigger cascading liquidity events as portfolio managers simultaneously reassess counterparty reliability and sovereign governance frameworks. The 1930s constitutional standoff between the executive and judiciary created persistent uncertainty that depressed equity multiples for 18 months. Today's ruling carries analogous contagion potential, not because markets fear Trump directly, but because they recognize the institutional fragility that judicial intervention exposes. When confidence in legal immunity structures evaporates, overnight, the hidden leverage embedded throughout corporate and hedge fund portfolios suddenly becomes visible. Buffett's measured response reflects this reality. He recognizes that systemic trust, once fractured, requires years to reconstitute. The market isn't panicking. It's pricing in the cost of operating within newly clarified legal constraints à recalibration. That reverberates through credit markets, option pricing, and capital allocation decisions for quarters ahead. The USD strength relies on perceived institutional stability. Constitutional chaos directly threatens dollar demand globally. When the Supreme Court's decision exposes fractures in America's governance architecture, foreign central banks and sovereign wealth funds recalibrate their confidence equations. This is not theatrical, it is mechanistic. The dollar's reserve currency status rests fundamentally on the assumption that institutional checks and balances remain robust and predictable. Each constitutional confrontation erodes that perception inch by inch. As international actors diversify holdings away from USD-denominated assets, the currency faces quiet but relentless selling pressure that rarely appears in headlines. This silent mechanism operates through reserve accumulation patterns. Central banks reduce new dollar purchases, accelerate alternative currency allocations, and gradually shift settlement mechanisms. The deterioration is structural, not cyclical. When trust in institutional legitimacy weakens, liquidity itself becomes volatile. Buffett's measured response reflects this reality. Seasoned investors recognize that fiscal strength cannot compensate for political unpredictability. The dollar's dominance depends entirely on perception of American institutional integrity. Threaten that perception, and you threaten the foundation of global financial architecture itself. Corporate leadership exposure. CEOs, unhedged political risk. C-suite executives face increased legal and reputational exposure. This creates behavioral unpredictability in capital allocation decisions that destabilizes institutional portfolios. When a CEO confronts personal legal jeopardy, whether through political exposure, regulatory investigations, or reputational collapse, the psychological calculus shifts fundamentally. The executive no longer optimizes purely for shareholder returns. Survival instincts override fiduciary discipline. This manifests as capital hoarding, delayed investment decisions, and defensive balance sheet posturing. The mechanism operates invisibly within quarterly guidance and board-level strategic pivots. Investors rarely quantify this exposure because it resides in behavioral risk, not formal financial statements. Yet the consequences are severe. Executives facing political vulnerability become increasingly risk-averse, accelerating the decay of competitive positioning. Worse, they unconsciously transfer legal liabilities onto institutional shareholders through defensive corporate structures and contingent reserves. The Supreme Court's immunity denial crystallizes this threat. When leadership lacks constitutional shields, corporate governance becomes weaponized. Capital markets function on predictable managerial behavior. Unpredictable survival-driven decisions corrode the trust architecture entirely. This is not mere headline risk, it is systemic fragility disguised as normal operations. Now, we move from mechanism to systemic impact. How does this judicial shock spread through interconnected financial networks? The Supreme Court's immunity denial creates immediate uncertainty that destabilizes the foundational premise upon which modern capital markets operate: predictability. When institutional investors lose confidence in political stability, they reassess risk premiums across all asset classes simultaneously. This cascading repricing manifests first in equities. But the true danger emerges in credit markets, where bank balance sheets face mounting pressure. Securities tied to politically sensitive assets become illiquid overnight as market makers widen spreads defensively. The leverage embedded in institutional portfolios, often invisible to casual observers, amplifies these moves exponentially. Buffett's measured response masks deeper concern. He recognizes that court-induced volatility can trigger forced liquidations among leveraged positions, draining banking system liquidity precisely when institutions need it most. The contagion pathway is neither speculative nor theoretical. It is mechanically inevitable when trust in governance structures fractures, forcing financial institutions to simultaneously raise capital buffers while assets they hold as collateral depreciate. This is systemic fragility disguised as normal market function. When institutional investors lose confidence in political predictability, they begin defensive repositioning en masse. This is not speculation. It is documented market behavior rooted in rational self-preservation. The Supreme Court's immunity decision represents a structural blow to institutional confidence in governmental predictability, triggering what analysts term political risk premium compression. Large asset managers holding concentrated positions in equities face an immediate calculus: maintain exposure to volatility or rebalance into defensive assets, bonds, precious metals, or cash equivalents. What makes this particularly acute is the systemic nature of the response. When the top 1% of institutional investors simultaneously reduce equity exposure, it creates cascading liquidity pressures. Buffett's muted public response should not be misinterpreted as complacency. Rather, it reflects the reality that megacap holdings cannot be rapidly liquidated without moving markets themselves. This creates a dangerous asymmetry. Institutional portfolios are increasingly illiquid precisely when political fragmentation demands agility. The real danger lies not in individual portfolio decisions, but in their aggregation when confidence collapses. The machinery of modern finance seizes because it was engineered for consensus, not crisis. When respected voices signal concern, momentum investors interpret it as a sell signal, creating artificial downward pressure that transforms perception into market reality. This mechanism, what behavioral finance scholars term informational cascades, reveals a fundamental vulnerability in institutional architecture. Buffett's measured warnings about market valuations carry disproportionate weight not because of empirical evidence alone, but because his reputation functions as a trust multiplier. When capital allocators of his stature exhibit caution, subordinate investors abandon independent analysis and follow the leader, regardless of underlying fundamentals. The cascade accelerates as algorithms detect selling pressure and execute pre-programmed liquidations, compounding losses. What begins as rational prudence becomes contagion. Portfolio managers, fearing reputational damage from holding deteriorating positions, capitulate faster than data justifies. The self-fulfilling prophecy completes itself. Markets decline not because conditions inherently warrant it, but because belief in decline becomes sufficiently widespread. This exposes a profound systemic fragility. Our markets rest upon confidence architectures, more precarious than technical analysis suggests. When institutions lose synchronized faith simultaneously, no circuit breaker restores equilibrium instantaneously. The institutional panic becomes the catastrophe itself. Fiscal credibility depends on political stability. Any signal of governmental dysfunction reverberates through the Treasury curve with the force of a systemic tremor. The Supreme Court's rejection of presidential immunity claims has crystallized a critical inflection point. Markets now confront the reality that institutional checks operate with tangible consequences, not merely as constitutional abstractions. This institutional assertion, while legally sound, introduces acute uncertainty into the macroeconomic calculus that underpins government bond valuations. When political legitimacy erodes even procedurally sovereign bond yields, respond by pricing in a stability premium, reflecting investors' rational fear of fiscal mismanagement or policy reversals. The mechanics are unforgiving. A widening Treasury spread signals diminishing confidence in the government's capacity to service obligations. Warren Buffett's muted response speaks volumes. Seasoned capital recognizes that confidence itself is the underlying asset. Without it, the entire debt structure destabilizes. Bond markets don't forgive ambiguity about political cohesion, and that ambiguity now dominates the landscape. Investors must grasp this fundamental vulnerability. Systems built on trust collapse fastest when that trust fractures. International investors may begin rotating capital away from U.S. exposure, a subtle but devastating capital drain that exposes the paradox underlying modern financial markets. When institutional portfolios diversify away from assets perceived as politically unstable, the mechanism operates silently. Foreign holders of Treasury bonds, equities, and corporate debt reassess risk premiums. The Supreme Court's immunity decision, coupled with mounting constitutional uncertainty, creates a credibility deficit that transcends traditional economic metrics. Emerging markets suddenly appear comparatively stable, a perception shift with cascading consequences. Capital flight doesn't announce itself through dramatic headlines. It materializes through redemption requests, margin calls, and liquidity crunches that transmit contagion across interconnected systems. The irony is devastating. A developed economy's institutional safeguards designed to protect against tyranny become interpreted as operational risk by global capital allocators. When confidence erodes, liquidity evaporates. Foreign central banks and sovereign wealth funds, long anchors of stability in U.S. markets, become potential sellers. This capital exodus, seemingly rational on individual balance sheets, collectively destabilizes the very system that underwrites global financial architecture. The ruling doesn't just affect current events. It fundamentally alters how elections are perceived as risk events by asset managers. This Supreme Court decision functions as a circuit breaker in the political-financial nexus, forcing institutional investors to recalibrate their exposure models. When judicial institutions signal that executive power constraints are enforceable and non-negotiable, markets face an unfamiliar variable, genuine uncertainty about political outcomes. Election cycles have always generated volatility, but 2024 to 2025 introduces a qualitatively different risk architecture. The elimination of immunities creates cascading implications for policy continuity, regulatory stability, and corporate tax forecasting. Large asset holders now confront an uncomfortable reality. Their portfolios depend on political actors operating within previously untested legal constraints. This structural shift compresses liquidity margins precisely when rebalancing pressures mount. Volatility amplification emerges not from partisan ideology, but from the mathematics of repositioning. When confidence in institutional predictability erodes, institutions flood exits simultaneously. The damage crystallizes not in isolated losses, but in contagion effects across correlated asset classes. Warren Buffett's cautious response reflects an uncomfortable acknowledgement. Systemic resilience depends on trust mechanisms that are, demonstrably, more fragile than consensus narratives suggest. Credit default swaps, equity options, and leveraged ETFs are structured around assumptions of political stability. Those models just broke. The derivatives market, which notionally exceeds $600 trillion globally, operates on mathematical frameworks built during decades of institutional continuity. When the Supreme Court's immunity ruling shattered predictability around executive power, a cornerstone assumption in risk modeling, it exposed a systemic vulnerability that most portfolio managers simply did not price correctly. Consider the mechanics. Financial engineers embed political risk premiums into their calculations using historical volatility data and correlation matrices that assume orderly transitions of power. The court's decision introduced genuine legal uncertainty regarding executive constraint, forcing recalibration across billions of dollars in leveraged positions. Banks and hedge funds holding synthetic short positions on market volatility now face cascading margin calls as realized volatility exceeds their value at risk thresholds. The contagion threat extends downstream. Pension funds, insurance companies, and retail investors through leveraged ETFs carry indirect exposure to these destabilizing derivatives without fully understanding the leverage chain beneath their holdings. When trust in institutional guardrails erodes, the entire architecture of quantitative finance, which depends on stable parameter assumptions, becomes dangerously fragile. The impact won't be immediate and dramatic. Watch for subtle shifts in credit spreads, currency volatility, and sector rotation. When legal certainty erodes, particularly regarding executive power and accountability frameworks, institutional investors recalibrate their risk assumptions in ways that cascade through seemingly disconnected markets. The Supreme Court's immunity ruling signals a fundamental realignment in the rule of law premium that underpins all asset valuations. Over the coming weeks, expect credit spreads to widen modestly as bond markets price in heightened political uncertainty and potential policy instability. Currency markets will prove most sensitive. International capital will test the stability of dollar-denominated assets when systemic confidence falters. Simultaneously, defensive sector rotation will intensify. Utilities, healthcare, and consumer staples will attract flows from economically sensitive equities. The mechanism is unforgiving. Confidence is the invisible collateral behind every financial transaction. When that collateral weakens, liquidity tightens first at the margins, then spreads inward. Buffett's measured response reflects this reality, not panic, but recognition that fragile systems require constant vigilance. This is the mathematics of systemic fragility made manifest. Consider long-duration treasuries flight to safety plays, defensive dividend stocks, and international diversification as tactical hedges against the institutional tremors we are witnessing. When constitutional certainty fractures as evidenced by the Supreme Court's definitive rejection of presidential immunity claims, market participants instinctively retreat toward assets, uncorrelated with political volatility. Long-duration government bonds serve as the ultimate confidence mechanism they are, denominated in the state's monopoly on coercion, rendering them the last refuge when systemic trust erodes. Defensive equities, with entrenched moats and steady dividend histories, buffer portfolio losses during periods of elevated policy uncertainty. International exposure, particularly to stable sovereigns and commodities denominated in alternative reserve currencies, decouples portfolio performance from domestic political risk. This is not speculation. It is portfolio architecture rooted in the recognition that financial markets are fundamentally confidence-dependent systems. When political institutions signal instability through judicial decisions that challenge executive authority or market dislocations tied to governance questions, capital flows reorient toward tangible, predictable income streams. Buffett's measured response underscores this reality. Defensive positioning is not pessimism. It is rational risk management in an environment where institutional legitimacy has become a priced asset. Block 23, the Buffett Playbook. Buffett's response teaches us that periods of uncertainty create opportunities for disciplined investors, but you must maintain optionality. This is the cornerstone of his dry powder strategy, the deliberate accumulation of liquid capital during euphoric market cycles, positioned to deploy when systemic stress fractures confidence. The recent Supreme Court decision amplifies this principle. Political volatility, regulatory uncertainty, and cascading institutional doubt destabilize the psychological scaffolding that markets depend upon. Buffett understands what most retail investors ignore: liquidity is power during dislocations. When asset valuations decouple from intrinsic worth, when leverage-dependent positions unwind, when counterparty risk suddenly materializes, dry powder becomes salvation. His patient capital approach isn't passivity. It's calculated predation. He maintains psychological separation from prevailing market narratives, resisting the compulsion to deploy capital in trending sectors. Instead, he accumulates flexibility, waiting for moments when fear liquidates assets below replacement value. This posture requires intellectual fortitude, watching others profit during bull markets while you sit in cash equivalents. Yet history confirms his thesis repeatedly. Crisis periods redistribute wealth to those who maintained purchasing power when others panicked. This is the core vigilance practice. Audit your investments for hidden dependencies on political certainty that may no longer exist. The Supreme Court's rejection of presidential immunity fundamentally destabilized an implicit assumption undergirding countless portfolio allocations, namely, that executive power maintains predictable constraints. Most investors unknowingly embedded this assumption into their risk models, treating political frameworks as immutable infrastructure rather than contingent social constructs. When Warren Buffett's measured response signals concern, it operates as a canary in the institutional coal mine. The real exposure lies dormant. How many equity positions, derivatives hedges, and fixed income allocations assume continuity of governance structures that now face genuine uncertainty? This reveals the hidden leverage within supposedly defensive portfolios. Investors holding financials, energy, and healthcare equity stakes are implicitly short on political stability without recognizing the position. The mechanics of confidence are fragile. When foundational assumptions, those never explicitly debated during portfolio construction collapse. Margin calls follow remorselessly. Your portfolio may already be underwater on assumptions it doesn't yet acknowledge. The volatility ahead stems not from earnings surprises, but from the systematic repricing of what safe actually means in destabilized institutional environments. To stay ahead of the next hidden fracture, join our community of institutional-grade risk monitors. Because the Supreme Court's rejection of presidential immunity signals something far more consequential than legal precedent. It exposes the fragility of institutional guardrails themselves. When Warren Buffett reacts to such decisions, astute investors recognize he's calibrating his exposure to systemic breakdown. The real vulnerability isn't in any single ruling. It's in the market's assumption that legal frameworks provide stable foundations for asset valuations. They don't. Markets function on collective faith that institutions will maintain their protective function. That faith cracks when courts contradict executive expectations, when regulatory clarity evaporates, or when political uncertainty translates into balance sheet contamination. Our weekly surveillance briefing tracks the microfractures, yield curve inversions, hidden leverage concentrations, counterparty resilience metrics, and confidence indicators that precede systemic contagion. These aren't abstract economic indicators, they're early warning mechanisms for institutional malfunction. The investor who understands that today's legal shock becomes tomorrow's liquidity crisis remains positioned defensively.